Okay, let's talk about a really weird day in the markets, December 11th, 2025. This was the day the market got what should have been great news and then just decided to rip itself in two. Seriously, one half was popping champagne and the other half was hitting the panic button. So what in the world happened? That's the mystery we're going to unravel today.
Yeah, this is the big question, right? How is it possible that a positive announcement from the most powerful central bank on the planet leads to a day of just total chaos and contradiction? It makes no sense on the surface, so let's dig in and unpack this whole puzzle piece by piece.
And look at this. This is basically the scene of the crime. You've got the Dow Jones, which is full of all the big, old-school industrial companies, hitting a brand new all-time high. Fantastic! But at the exact same time, the tech-heavy NASDAQ just takes a nosedive. It's like the market had a complete split personality. So what was going on? To really get to the bottom of this, we first have to look at the one event that was supposed to make everybody happy. It seems the market didn't just split that day, it fundamentally broke. And like in any good mystery, our investigation starts with the usual suspect, the U.S. Federal Reserve. They made a huge announcement, and that's what set this entire chain of events in motion.
The Fed pretty much holds the keys to the entire economy, and their decisions can send these massive shockwaves through the whole system. So let's break down exactly what it is they did.
First off, a quick refresher on interest rates. Just think of them as the brake pedal for the economy. When things are slowing down a little too much, the Fed can ease its foot off the brake. That is, cut rates, to make sure the whole car doesn't just stall out. It's supposed to be a good thing, a signal that they've got things under control.
And that's exactly what they did. They cut interest rates by 25 basis points, which is really just Wall Street jargon for a quarter of a percentage point. This was what everyone was expecting. It was supposed to be the green light investors had been waiting for. But it wasn't nearly that simple.
Because the real story, the juicy part, was buried in the fine print. Behind that headline number, the Fed's own committee was completely fractured. They couldn't agree on the right move, and that sent this subtle but very powerful signal of uncertainty out to the market.
And this chart just shows you how divided they were. Look at this. The final vote was 9-3. So yeah, you had the main group of 9 who wanted that small cut. But then you had 2 hawks. Those are the folks worried about inflation who wanted to do nothing at all. And on the complete other side, you had 1 dove who wanted an even bigger 50-point cut to really rev up the economy. A 3-way split like this is super rare, and it basically screamed to the markets, we're not really sure what's coming next.
The Fed also made a second move. They started buying some short-term government debt, but they made a huge point of stressing this was not QE, not quantitative easing. What's the difference? Well, QE is like injecting pure caffeine into the economy to jolt it awake. This other move was more like just putting some oil on the gears of the financial system to make sure everything keeps running smoothly. It's a technical fix, not a massive stimulus.
So let's put it all together. The Fed is easing off the brakes, and they're making sure the whole financial system is well-oiled. By all accounts, this should be party time for every single part of the market, especially for those high-growth tech stocks. So what in the world could have gone so wrong for them?
Well, it turns out on that exact same day, a completely different story was unfolding, and this one had nothing to do with the Fed. It had everything to do with the biggest investment theme of the last decade, artificial intelligence. And this, my friends, is where our mystery takes a very sharp turn. While everyone was glued to their screens watching the Fed, a single company was about to drop an absolute bombshell. And that company was Oracle. So Oracle released its earnings report, and man, it was a total gut punch. First, the revenues were a little shy of what people expected, a bad sign. But the real shocker was their spending plan. They announced they were getting ready to drop up to $50 billion on AI. The market's reaction? It was brutal. The stock just cratered.
And all of a sudden, this one single terrifying question started echoing across Wall Street. Where is the return on the investment? For years, investors had just been pouring money into any company that had AI in its pitch, just assuming that all that massive spending would eventually lead to massive profits. Oracle's report was the first major crack in that story.
And that fear, it became contagious, spreading like wildfire. The thinking went something like this. Wait a minute. If a giant like Oracle is spending billions on AI and not seeing the sales to match, who else is doing the same thing? And instantly, all eyes turned to companies like NVIDIA, the darling of the AI boom, and people started to panic, selling off stocks across the whole tech sector.
This panic triggered one of the fastest and most dramatic shifts of money that we have seen in years. It's a phenomenon we call the Great Rotation.
And a really simple way to think about it is this. Investors basically did a complete wardrobe change with their money, all in a single day. They threw out all the trendy, super expensive AI outfits and put on the classic, reliable blue jeans instead.
This chart shows you exactly where the money went. You can see this huge river of cash flowing out of technology. And where did it go? Straight into sectors like banks and industrials. You know, the exact kind of companies that fill up the Dow Jones Index.
So, it all came down to this simple, two-step process. Step 1, money fled from the expensive tech companies because their AI profits were suddenly in question. Step 2, that exact same money poured right into the real economy companies, the banks, the manufacturers, because they get a direct and immediate benefit from lower interest rates. And just like that, the Fed's good news suddenly only mattered to one half of the market.
So what does all this chaos mean for the future? Well, this one wild day gave us a really clear verdict on what the market might look like heading into 2026.
It feels like we now have two completely opposing forces driving the market. For tech, the age of pure hype is over. They're now facing a serious headwind where they have to prove all that AI spending actually leads to real profit. But at the same time, the old value economy now has a tailwind because the Fed's rate cuts make it cheaper for them to borrow, to build, and to grow.
I think the big takeaway here is this. The market has changed. You know, for the last few years, that saying, a rising tide of easy money lifts all boats, was true, especially for the tech boats. Well, that era is over. Investors are now being way more selective, and the game has become a lot more difficult.
And that leaves us with the ultimate question. The Federal Reserve has made its move to support the economy. The ball is now in the court of the companies themselves. With investors watching every single penny, can they finally prove that they are worth their sky-high prices? That is the multi-trillion-dollar question for 2026.